Hello and welcome to our new investment strategy update. This is a time of unprecedented challenges for the world economy. The trade war between the US and China has sucked the oxygen out of the global economy. Never have the patterns of trade been altered so radically in such a short span of time. US tariffs have now reached substantial levels. Global activity started to feel the pain in late 2018, and a deal likely to bring tariffs back to the level that prevailed back then, or completely remove them, seems a long way off. It is indeed difficult to imagine economic relations between the US and China normalizing anytime soon. Yet, only a significant de-escalation can set the stage for a revival of global growth. Now, this leaves one crucial question. Will the trade shock lead to a recession in the US and potentially everywhere else? The answer is no at this stage. So far, the continued resilience of the US consumer, healthy job and wage growth, improving housing, and low fuel prices are keeping the threat of a recession at bay. Furthermore, credit conditions in the US and even in Europe are still pretty supportive. And there is another crucial support. Central banks are running the monetary pumps to full power to make the atmosphere more breathable and ease some of the strain. It is clear, however, that in the absence of further fiscal measures, monetary policies cannot make the economies wholly immune from the impact of the trade conflict. Also, the UK remains in uncharted territory as Brexit tests the fabric of British politics. While everything points to new elections in the coming months, the risk of a disruptive outcome is still very much alive. So, where does this leave investors today? Well, let's turn to Stéphane to discover how slowing growth and supportive central banks are influencing our portfolio positioning.
Financial markets are indeed evolving under the influence of two opposing forces whose shifting tides are raising the stakes for investors. The negative forces of the US-China trade war and Brexit, and the positive tide of central bank support. Faced with this uncertainty, we keep a balanced risk exposure while making sure that our clients' portfolios stay resilient to market shocks through several protections, namely gold, long yen position, and long put options. But while portfolio defenses are essential, there's more to this late cycle, and we still see opportunities to improve returns amid the challenges. In dollar accounts, we remain overweight fixed income given the significantly higher level of yields. We also continue to pursue carry strategies, mostly through emerging market debt in hard currency and corporate bonds. Elsewhere, government bonds are no longer a source of income nor a source of protection in market downturns. This is why we continue our strategic move to find alternatives to traditional fixed income, first carried out in November 2018 in Swiss franc portfolios through an increase in our allocation to real estate. We are now extending this strategy to cover all our euro portfolios. Real estate is indeed an attractive source of return with a 3% yield difference versus European government bonds. It is also more resilient to market stresses than equities. We maintain a cautious view on equities given the outlook for global trade. At this stage, we recommend investors protect this year's gain by implementing long put option strategies on equity indices. Finally, oil has seen major volatility in the wake of the recent attacks on Saudi facilities. We do not expect a long-term shock as today's reserves, including commercial inventories and strategic government reserves, can cope with abrupt supply disruptions. As the year winds down, the US-China relationship and Brexit remain the main risks that could spark more market volatility. And in times like these, portfolio positioning is a delicate balancing act. But as Samy explained earlier, while times are challenging, the cycle is not over yet. Thank you very much for watching.